Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Johnson & Johnson. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie. Well, let's run to the S&P 500 index chart. We do have a couple of things that I want to highlight here. We've had a lot of chop in the market recently. Earnings were extremely good in all the companies in the S&P 500 index overall. Most of the companies, I think over 80% of them actually beat earnings estimates, but we just couldn't go higher in the SPX and in a lot of the major indexes. But I'm going to highlight here with my cursor. I have my crosshairs right just on an interesting area. We are down today, down across the board in all the different indexes. And we just see this little area of support that was happening in this little area of chop. It's a very small area of consolidation in the S&P 500 index. So we did break below the 20-day moving average, and that has offered some support in the past in different areas, i.e. all the way back here at the end of March, we kind of saw where we got a little bit of support from the 50-day moving average. But so a little bit of weakness. What do we see going into the markets this week, Callie?
Yeah, Brian. Well, let's run to the chart is right. We've got a little bit of action today after quite a long period of quiet. So stocks are sliding again. The S&P has been down as much as 1.8% today after it fell 1% yesterday for the first time in nearly 2 months. Yesterday's drop was definitely unexpected. I was surprised. But if you dig into the details, and we're talking yesterday, it really was a story of one part of the market caving while the other just kind of meandered along. Today, no sector is safe. All 10 sectors, 11 sectors in the S&P are down. But yesterday was an interesting use case, and I think it really, gives us a hint to what could be coming. So yesterday, look at the divide between growth and value stocks. Growth stocks like high flyers and tech fell 2.1% on Monday, while value stocks, which are the slow and steady economically tied companies, only fell about 0.3%. Another interesting stat I picked up, there was an unusually small amount of stocks actually falling yesterday, given the S&P's overall reaction. If you want numbers, about 226 S&P stocks rose yesterday, while about 274 declined, which is the smallest spread between declining and advancing stocks on a day when the S&P fell 1% or more since, get this, December 2000. And better yet, to make the story even more interesting, nearly 40% of the S&P's members made 52-week highs. Tell me just that stat, and you'd have a really hard time convincing me that the S&P actually fell a decent amount yesterday. So yes, we're down today, but we are seeing a bit of buying pressure. And for me, it does really look like a tale of two markets. That has been the case for a few months now. And right now it's just weighing on the market, the overall market a little bit more. But that's a really big sign, and it feels like a clear sign to me that this particular pullback might not be the one everybody is expecting. Markets are clearly overextended. Brian and I talk about that every single week. You can see that with the moving averages. But this could just be a quick bout of profit taking and riskier stocks that could be over soon. To be fair, we need to set expectations here. Growth stocks woes are weighing on the rest of the market. It's pretty clear. And that could, turn into a 5 to 10% drop like we saw in September. However, we'd expect any significant dip to be bought quickly, especially because this particular sell-off wasn't spurred by any obvious economic catalyst. It just kind of happened. It's just another chapter of investors wondering what's lurking around the corner in a post-pandemic recovery. And honestly, we don't see anything ominous. So when does this end? That's the million-dollar question. It could end today. It could continue tomorrow. We don't know. It's tough to tell when sellers will be satisfied, but in a market with lots of buying interest, we'd guess it won't take long. There aren't a lot of catalysts this week to really move the market in one way or the other. There are two important inflation reports, one that comes out tomorrow, CPI, and then PPI, which I believe comes out on Thursday. And earnings season is still going on, although it's winding down a little bit. So the market's next move might be just up to how investors are feeling with a lack of catalysts on the horizon. Overall, we're still optimistic on stocks over the next 12 months. We're feeling really encouraged by the breadth metrics we saw yesterday, plus the buying pressure that we're seeing today. So put it all together, and this could be a good opportunity to pick up some hot names on sale. All right, Brian, that was a mouthful, and that was the rundown of what I'm seeing. So tell us what you're seeing in the VIX.
All right, so we have my VIX watch list up, and it kind of makes sense that since the market is down, we see the VIX spike up. And I'm going to highlight the spot down here. The VIX, the volatility index, that tracks the volatility in the S&P 500 index. It's at 2144, up about 9% or $1.78 on the day. And if we look at the chart of the VIX that I have over here on the right-hand side, we've been highlighting the 20% level ever since the downturn caused by the pandemic last March. And we have definitely broken above that level. 2144 means some nervousness is coming back in the marketplace. We go out into the end time, go out to the July, August futures contracts. We're up 48 cents in August, or about 2%. July, we're up 65 cents or 285. This is not unheard of. I mean, they're not large numbers. We're not seeing the VIX above 25% on the futures contracts, but definitely some nervousness has came back in. Whenever we see that VIX go up above 20% implied volatility, it means people are interestingly watching the markets and what's coming next. All right, so that gets us to the stock of the day, Johnson & Johnson. I have a chart of Johnson & Johnson here. And Callie, let's hear a little bit about the fundamentals of Johnson & Johnson and what they have to look forward to going into the end of the summer.
Yeah, Brian. Well, let's talk Johnson & Johnson, which I think is a good summation of, feeling long-term bullish, but feeling a little nervous right now, feeling a little cautious as we see markets fall. So J&J, we'll call it J&J, it's easier on the tongue. J&J, which is well known for its one-dose COVID shot right now, has bounced back strongly after its shot was briefly taken off the market in April. The stock is up about 5% since the end of April, and it's trading near a record high. In fact, I think it hit a record high yesterday, and it's down about 1% today. And the vaccine is available again. But a lot of that pop, while a good bit of it was due to that vaccine being put back on the market, a lot of that pop was due to a pretty good earnings report as well. That's the story we're not talking about. Johnson & Johnson did beat earnings estimates, and several segments of the business were unusually strong in the first quarter, even absent the vaccine. J&J even provided especially upbeat guidance without including the vaccine. And just right now, it does seem like the vaccine can only boost sales in the short term, even though there are still questions about its safety. Several analysts actually announced they're bullish on J&J stock after that earnings report, and the average 12-month price target is around $185, which is about 9% higher than where it's trading at right now. But here's the wrinkle. I mean, you've seen the market. J&J has risen a lot recently, and luckily it's bucked the trend of other biotech stocks because biotech in general has been down about 15% since the middle of February. Presumably investors are trimming back some of their growthier stock positions, some of the stocks that have run a little bit too far. J&J hasn't been hit by that, but it's always susceptible, and it is a stock that has done unusually well over the past 6 months. Don't get me wrong, J&J is not a growth stock. I'm not saying that. But again, it's a stock that has done fairly well recently. So it could be more susceptible to a pullback if the market continues to go down from here. So to sum it all up, we are long-term bullish on J&J, but we think it could be wise to protect your position right now. So Brian, I think we need an options trade that's bullish overall, but we need to think about maybe incorporating some hedging in case we want that option to sell in a market downturn. So I want to hear what you have for us, but before I pass it to you, I want to remind all of our users to drop your questions in the chat. because Brian and I will be answering your questions live at the end of the show today. And we're expecting some good ones given the market's action. So Brian, what do you have for us?
All right. Well, I'm going to start by looking at the chart. I'm just going to highlight a couple of things. So with Johnson & Johnson, this was the earnings announcement that you mentioned, and we did have a good run up, but it dropped down precipitously, like a lot of the stocks this earnings season. Jumped up on the news for a day, maybe a day, a half a day, and then started selling off. But I'm just going to highlight this one little area here. This is an area of interest. This is where we had a gap up. Here's where we actually hit a little bit of resistance on the upside, came close to it here, hit it again here, and we did actually just recently break out. Now, we got a little bit of weakness today, but honestly, the healthcare sector is holding its own today, much better than a lot of the other stocks. And this area right here is an area of interest. It'd be really nice if the underlying just bounces off of that and continues on up, kind of confirming the breakout to the upside. And it'd be nice if we could hit a new high in Johnson & Johnson, obviously overall. Now, one dose. I mean, if you're thinking about the fact that you have to distribute this to all the countries around the world, India right now, the U.S. government was going to send shots to India, try to help with their second wave during this pandemic. Johnson & Johnson just makes sense. It's a one shot, one dose event. Now, there have had some problems, and there's been a few problems with the AstraZeneca one and a couple others, but overall, they've determined that out of these shots, most of them are better to get the shot than not, as far as the health risks are concerned. Getting COVID is worse overall than any of the side effects of the vaccine so far. Okay, a little bit long-winded there, but let's jump into the option strategy. We see Johnson & Johnson now down 1%, a little less than what the overall markets are down. If we look at the strategy that I'm going to talk about, and Callie kind of mentioned that she a little nervous in the short term, but maybe a little bit more bullish long term. If we're going to go long term, there's two ways that we can hedge this. As opposed to buying the stock outright, Johnson & Johnson isn't a cheap stock. It's not an expensive stock. It's not Google. It's not Amazon. But it is a fairly expensive stock overall, $168 stock. To buy 100 shares of it, you're talking about $16,800. But the options are pretty liquid in the marketplace. They've already announced earnings. Their next earnings report I have is anticipated to be July 21st. So we're going to go out further in time, and we're going to buy a leap as a substitute for owning the stock outright. That by itself is hedging yourself because you're going to have limited and known downside risk. Now, if we want to take it to the next level and you want to sell something short term, you could do what's referred to in the options playbook as the fig leaf, also known as a leveraged covered call. We're buying the longer term option. In this instance, we were calling it a leap, but we're not going to go out 9 months in time. That's usually defines what a long-term equity anticipated security stands for. That's what a leap is. So we're going to go out to September, go out past the next earnings. We might sell a short-term call against it, effectively making this a covered call because we're buying the leap as a substitute for owning the stock, managing our risk that way. But if you're a little nervous about the shorter term in the marketplace, well, maybe you can sell a short-term call against it a little bit further out of the money. So let's look at both of these trades. Let's get into the Ally Invest option chains. We see Johnson & Johnson down $1.58. We're going to go start by looking at the September expiration. And since we want to buy this as a substitute for owning the stock, we want some delta. We're going to pay something for this option contract. And if we look at the 150 strike call option, run over to the delta column, that means that that delta is 83 cents, implying that if the stock went up 1 point, in theory, the option contract should go up about 83 cents. Now, it's a dynamic number and it's a theoretical number, but it gives you a decent feel for how much your option contract should move relative to a movement in the stock. Now, if we take a peek on the put side, that kind of shows us the amount of time premium we're buying. So this is a $19.70 option if we pay the ask for it, but we got about $1.95 worth of time value just by looking at the put. So keep that in mind in that we are buying a real option, a deep in the money option contract, but we're still paying some time value. So that eventually has to decay, but it's going to take 129 days for that time value to whittle away before we get to that expiration date on September 17th. Okay, so that's going to be the official paper trade. Now, by doing this option contract as opposed to buying 100 shares outright, so I suggest that if you're thinking about buying 100 shares of Johnson & Johnson, this would be the alternative. I would buy one longer term in the money option contract as a substitute. If I treat it that way, then I'm limiting my risk to what I pay for that. The midpoint is 1958. It's not as tight as the stock, and that's one of the issues with buying longer term in the money options is the width of the bid-ask spread. I might work it a little bit. I'm going to put it over here in the right rail, and I'm going to put it in, I'm going to say 1960. I'm going to lean a little bit higher than the midpoint of 1960, and this will be the official paper trade for the week. Now, if we only pay 1960 for it, we're talking about 13% is our total risk here. And whenever I take these type of trades on, I really want to limit my risk even more than that. And I always just set an alert where that underlying stock is at, right at that 150 level. The market comes down to 150, then that becomes an at the money option contract. And I would strongly consider just selling it and getting out. I was wrong on my forecast. It made a strong move to the downside because if I look at that 150 strike right now would be trading somewhere similar to where the 170 is at right now. Now there's time decay issues in that, but right now the 170 isn't at the money option contract and there's still a lot of time premium in it. So that would be my approach on my longer term leaps option. I'm not looking to risk that entire 1960 that we're showing here in the right rail. But if the market came down to the 150 level, that's great. If it goes up, it's simple. Life is easy, right? If we can get the market to hold that resistance level to the downside and or that support level to the downside and break up and maybe set a new high in the underlying stock overall. Okay, so now real quick, we got a couple of questions that are in here. Please put them in the chat box. But I also want to highlight the fig leaf. Okay, so here's the fig leaf strategy. We have our longer term option contract that we would consider. If you did want to manage this trade by selling a near term option, I would go out shorter in time and a little bit up in strike. Okay. If I'm doing a covered call on a stock, I want to bring in more premium. Why? Because I paid more for the stock than I did for the option contract. I don't mind giving up a little bit of premium and going a little bit further out of the money because I really don't want to be assigned on this position. So the fig leaf would look something like this. We go on in, we go out further in time, we buy that one option contract. Then if we look at that May position and we look at the 150 strike call, that's 10 days away, the May 21st expiration. Remember, we have about $2 worth of time premium in this, and I want to try to whittle away at it as much as I can. I don't want to be in a short option going into earnings, but that's out until July. So how could I whittle away at it? Now, I could go sell the 172.50, bring in 60 cents. That's okay. But ideally, I'm going to actually go up to the 175. And this is what we'd be looking at. You have 10 days to that expiration. That would be a solid move from 168 all the way up to 175. And the fig leaf strategy would look something like this. I would be buying that 150 strike call and at the same time selling the 175 strike call. If I scroll down to the profit and loss graph, you'll see that this looks a lot like the option strategy that we had inside the options playbook. You have a little bit of a bend because you're dealing with two different time periods, but we do have limited and known risk to the downside. And if you do put the fig leaf on, you can still get out prior to expiration. That option contract doesn't fixate you in that position. And if I do this, I want to make sure that if that underlying stock gets up to my strike price, 175, that I do something about it. But my whole goal here is to try to capture as much of that. I think it was 23 cents, we'll call it 22 cents, and help pay for some of the time premium that I'm paying in my longer term September option contract. All right, so there's the leverage cover call inside here. This is what it actually looks like in the profit and loss calculator. And I think we'll open it up for questions.
Yeah, let's go, Brian.
All right.
Good explanation
What do you got,
there.
Callie?
Always love a good fig leaf trade. All right, so we have a few questions. The first comes from Fire Mip Spy. Hi, Fire Mip Spy. Apologies if I didn't pick up on the right saying of those few words. So Fire Mip Spy, first question is, how do you know there is a lot of buying interest? Well, that's a really good question. It's a little anecdotal and it's a little data driven. So the reason why I said that is because we are seeing a lot of market stabilization around important levels. And I'm not the chartist here, but around certain technical levels like the 20-day, like the 50-day. In the past, the S&P has seen a lot of really good support. So that indicates to me that there's a lot of buying interest, a lot of interest to come in when the S&P does fall to certain levels. And then going back to breadth yesterday, breadth was incredibly encouraging, even though the market was already down. I mean, we're still seeing industrials, or not industrials, but we're still seeing bigger cap stocks, large cap stocks that are more economically exposed, stay fairly strong in this market pullback when we're, on the other hand, when we're seeing growth stocks, sell off quite a bit. So there seems to be some interest in areas of the market, even though growth stocks are being hit very hard. So again, mostly anecdotal. I will add too that the S&P did go 35 straight sessions without a 1% drop. And that is very unusual. And that shows to me too that there's a lot of buying interest out there. Investors aren't letting the market fall, more than 1% up until this point. And we've seen the S&P was down about 1.8% today, but at its worst point. But now it's only down about 90 basis points. So that's rebounding half the way back up. So again, lots of buying interest. It makes sense. The Fed is supportive. We're in a high growth period. Everybody's clamoring at the bit to see, what this post-pandemic recovery looks like. So that's why I said that. All right. And then I have another question from Firemip Spy, and this is for you, Brian. So right. Firemip Spy says, so if you buy a call out in the future, and let's say your short-term call gets exercised, what does Ally do? You don't actually own the shares. So does Ally auto exercise the leap?
All right. Okay. So I am showing the options playbook, and I'm going to highlight a section called rolling a covered call. And I also see Wayne's question in here. So this will kind of address that too. Yes, if you do this position, and part of the reason we went to the 175 is we want to avoid being assigned. But if you are close to that strike price, I strongly suggest you read this section of the option playbook called managing positions, rolling a covered call. One thing you can do is you could roll that covered call. You should be up on the position, so you could just close it out. But you really don't want to be asleep on the expiration date of the short-term option contract. You want to do something with that. Ally Invest is going to try to call you, but bottom line is they're going to do what's best for all the clients at the firm. They're going to try to manage that risk. So to determine if they're going to exercise that leap, it depends a lot on the funding that you have in your account. They may just close the position overall. And trust me, you're not going to like that if they have to do that, because they're just going to be closing it at market. But they have to remove that risk if they're afraid that you're going to be assigned and get short stock in your account. So what do I say? Don't allow it to happen. Just make sure that you're alert one day of the next 30 some days, right? And you go in and either roll the position, buy the position back, or just close the covered call and allow the long-term option contract to run. So I do say that this is a little bit more risk than a covered call because you own the stock. You really don't want to assign your longer term option here in 10 days. And the main reason why is that you still have $2 worth of time premium. So if you did fall asleep and you were assigned, here's how I would handle it. I would get up in the morning right away and I would sell my long-term option contract to generate some cash, go out, buy the stock, and award that to Ally for that assignment. Back to you, Kelly.
All right, Brian. Good answer. Good answer. Well, we have to end this a little bit early. Brian has a personal thing he has to attend to. So, Wayne, hold that question on growth and value stocks. We'll try to address that next week. And In the meantime, you can check out Lindsay and I. We write a lot about growth and value stocks and the difference between them on the Community Hub. So definitely check that out. But for today, I think we'll wrap it up. Thanks for joining us. And if Brian doesn't mention it, I will. We do a stock play of the day overtime every Friday. Brian revisits the trade and he sees how we do. He sees how we're doing and talks about how you can adjust the trade. So definitely check that out. It's 12 p.m. Eastern every Friday. And I'll let Brian take us out.
All right, everybody. So please click subscribe and ring the bell, and we'll see you this Friday for the Stock Play of the Day Overtime Edition. Thanks for coming, everyone.